Good evening, everyone, and thank you for joining us again on our third webinar of the year. And this is one I have been extremely excited about. I've been fortunate to attend this live a couple times, and I was just adamant that we have to get this on for for our listeners. So today we are happy to have Joe Kingsley with us from Inland Securities. And we are going to delve down into tax advantage real estate strategies. Biggest thing that we preach in the practice, there are two things we can control: cost and taxes, and taxes being the big one. So without further ado, I'd like to introduce everyone to Joe Kingsley with Inland Securities, and he's going to be our facilitator this evening for our study on tax advantage real estate strategy. So Joe, take it away.
Thanks, Marcus. Thanks, Jeff. So appreciate you taking the time to let me join you on the webinar here tonight. And I've had the opportunity to meet Marcus and Jeff in Raleigh a few times over the past couple of years. So the topics for tonight are really real estate solutions that offer some significant tax advantages and the tax codes that you can use to defer taxes, reduce taxes, and then in some cases, eliminate taxes completely. So a little background on us. Inland's been around since 1968. So we're a 58-year-old real estate company. We've managed over $50 billion for almost 500,000 since our founding as a company. And we tend to do investments in three different strategies. So we've got the tax side. Those are 1031 exchange programs, and then also qualified opportunity zone funds. 31s can be used to defer taxes from the sale of any real estate other than the house that you live in as your primary residence. So any other real estate that you might be selling, you can defer all your taxes by using the 1031 tax code. And then opportunity zone funds are a little broader use tax code, where you can defer capital gain tax liability from the sale of any asset, whether it's stock or a business or real estate. Anything that's a capital gain tax liability, you can use in an opportunity zone fund to provide some tax benefits. And then we also do some private funds, development funds from time to time. And then we have an income and growth strategy for investors that just want to make a cash investment, either in their IRA account or their normal brokerage account, and produce some income from real estate. The strategy on that side, the current income rate is 5.42% annualized. That's paid every month. And 100% of that was tax sheltered last year on the 1099 tax return. So none of that was taxable. It was all non-taxable income. So on the 1031 side, Inland's the oldest company in the U.S. That offers 1031 exchanges. We've done over 300 1031 exchange programs for investors over the course of our history. If you think of kind of where we're at right now in the real estate market, we're just coming out of a downturn. So what this chart here shows is the returns of the institutional real estate index, directly owned properties by institutional investors. And it goes back about 36 years. So this index has had three downturns, really. So we had one in the early 90s. We had a bigger one in the 2009, 10, kind of coming out of that 2011 downturn. And then we had another downturn kind of right after COVID, when the Fed started raising rates again. It put a damper on the real estate market. And in the third quarter 2024, we saw the first positive return kind of coming out of that downturn. Last year was positive too. So the returns last year for that same index were right about 5%. we've got it broken down by sector here too. So some of the sectors last year with higher returns than average, manufactured housing and RV parks, that was actually number one. Senior housing, retail made a bit of a comeback last year. Self-storage, data centers, medical treatment centers, apartments, those are all kind of above the average return. But we think we're at a good point in the cycle. Usually when you come out of one of these downturns, the returns can be a little higher for the next few years coming out of a downturn. So if the Fed lowers rates a little more later this year, that'll definitely help stimulate the market a little more too. So what we do at Inland, we've always done a lot of apartments. We did retail and office quite a bit in the 70s, 80s, and 90s. And then the last 10 years or so, we started investing in some of these sectors that have had higher returns than average. So, and less volatility too. So they just don't move around quite as much. So some of those are self-storage, student housing. If anyone's in Raleigh on the webinar that listens to this, we do own the College Inn right outside NC State, like right across from the main entrance. We own properties at ACC schools, Florida State, NC State, SEC, Tennessee, Auburn, Georgia, Clemson, a lot of bigger Southeast schools we own properties at. And then we do senior living, manufactured housing communities, medical treatment centers as a focus at Inland. And we really kind of do that across the different fund structures that we offer. The 1031 tax code, this has been around since 1921. So it's a 105-year-old tax code. It's over a century old. And what it really allows you to do is you can sell any property type that you're not living in. So as long as you're not living in it as your primary residence, you could sell any residential property, any commercial property, any land, whether it's farmland, timberland, undeveloped land, that's all eligible. And as long as you reinvest your proceeds into real estate, then you'll defer all your taxes when you use this tax code. Everything qualifies in the eyes of the IRS as a like kind, similar property. As long as you're not living in it as your primary residence, then you could sell it and invest in anything else in real estate. If you sell, let's say you've got a VRBO beach house down on the beach, you can sell that and buy an interest in a storage facility, industrial warehouse, apartment complex, anything. If you sell a farm, you can invest in any other kind of real estate. It's really a broad definition. And if you're thinking of doing a 1031, the most important thing is before you sell your property, talk to somebody like Marcus and Jeff here. So you need to have a plan in place before the property is sold. And part of that plan is you have to establish an account with what's called a qualified intermediary. That account needs to be set up before you sell your property. And then what happens is once you sell the property, the money's held in escrow by that intermediary company. Then you have 45 days to create a list of options that you might want to purchase and 180 days to make those purchases. Those dates don't change unless there's some sort of a federally declared emergency like a hurricane or something like that. And then from an investment standpoint, when you use the 1031 tax code, you can either buy your own property and manage that property again, or you could buy shares of a fund. And we offer funds at Inland called DSTs. That stands for Delaware Statutory Trust. And in these, we'll buy one big property, like a big apartment complex or a big Amazon distribution center or something like that. Or we'll buy a number of properties and put it all in one DST. We have a self-storage one, for instance, that owns 5 Florida property locations, one in Greensboro, North Carolina, and one in suburban Nashville, Tennessee. So that's all in one DST. But you pick a DST to invest in, the property's already purchased, and it's already paying cash flow. So these programs pay monthly income, and the rates are generally anywhere between 4 and 5%. You don't have to manage anything. We manage the property for the investors, and the investors get their monthly checks. And typically, about half of the income that they get from a DST is not taxable because of depreciation that's coming from the properties that's in the program. So it's the same concept that if you own a rental property and your accountant depreciates it over time, you get the benefit of that depreciation, sheltering part of the rental income. It's the same thing with a DST. So with these, generally we're going to own the property for 5 to 7 years and then sell it and then return the proceeds to investors along with any gain from the sale of the property. And then you can decide if you want to do another 1031 exchange at that point and just keep deferring your tax bill. So from a tax standpoint, there's 4 taxes that you have to pay when you sell real estate. When you use the 1031 tax code, you defer all 4 of those. The taxes that you have to pay if you don't do a 1031, let's say you buy a property for $100,000 and then your accountant depreciates it down over time, over the life of the ownership, and you depreciate it all the way down to 0 as far as a cost basis. If you sell that property for $1 million, the first tax you have to pay is that depreciation that's being recaptured when you sell the property. And the tax rate on that gets as high as 25%. So that's due to the IRS. Then you'll have the federal capital gain tax. North Carolina, is it going to 4.25%, Marcus? Is that what the tax rate is going to? I think
We're actually going down to 4.
4. Gotcha. So that one would be a little bit lower than what I'm showing here. And then if the property is $250,000 or higher, you get subjected to another tax called net investment income tax of 3.8%. So usually when you sell real estate, if you just decide to pay your taxes, you're going to pay about a 30% tax bill on the whole thing. That's typically average. So if you sell for $1 million, you might end up with about $700,000 after paying taxes. If you do a 1031 with $1 million and you reinvest the full $1 million, then you defer all your taxes. So you keep that $1 million working for you in real estate, and the income that you'll get from that would be $40,000 to $50,000 a year, typically from a DST program. You only pay taxes usually in about half of that income, and then over time, let's say the real estate appreciates in value 20% over the 5 years or so that we own it, and then we sell the property, your $1 million might be worth $1.2 million or something of that level. And when we distribute those funds, you can decide if you want to do another 1031 exchange and reinvest the new amount, the 1.2 million, and defer all your taxes all over again. So as long as you keep doing 1031s, you keep deferring your taxes. And then ultimately, if you do these throughout your lifetime, and then you leave the shares to a beneficiary someday, the heirs don't receive a big tax bill. So the heirs would receive the investment value, but they don't have to go back and pay the old taxes that the original owner has been deferring. So it can be a real nice estate plan for clients that are getting a little bit older. Maybe they own property currently and they're getting tired of managing it and dealing with the tenants and keeping up with the insurance and the taxes and repairs and everything. They'd like to sell their property, but they don't want the big tax bill. If you sell and use the 1031 tax code and invest in a DST, then you get out of the property management into the business, you make monthly income, and then if you pass it on someday to beneficiaries, they don't inherit the tax bill. They'll just inherit the proceeds from the investment. Let me pause there, Marcus, and see if there's anything that you want me to cover in more detail on the 1031. And then I could talk about the opportunity zone tax code too, if you'd like.
Yeah, no, that was great introduction to the real estate piece, and you hit both sides of how a person could either continue and have property and defer, or they're towards the end of their management wits and they want to go a different route to go there. So no, that was perfect. I think the last piece, just to be clear, as Joe was talking about the beneficiaries and the taxes, that would be due to that step up in basis of the property. And that's why a person, when they pass and the beneficiaries receive the property, they would have the ability to sell because of the step up in basis and not incur a tax bill. And that's another huge part of the tax code. So yes, absolutely. So yeah, let's move on to opportunity zones, because we've got a lot to talk about there. And this also gives us the ability for not only real estate capital gains, but other capital gains. So our business brokers who are on the line, our business owners who are about to sell a business and face capital gains, here's an opportunity for us to manage those taxes as well. So yeah, let's get into that.
That sounds good. So the opportunity zone tax code was written back in 2017. It was part of the Tax Cuts and Jobs Act. It's going to expire at the end of this year, but then they're reinstating it next year and enhancing it next year. So they're calling it Opportunity Zone 2.0 for the next tax code that starts January 1st, 27. And the whole intent of this really was to attract investments into areas the government considered underinvested and create jobs for the residents, economic opportunities, improve the tax base for the community, to improve schools and fire and police departments and those kind of things, and really improve communities by attracting investments to these areas. Right now, there's 8,700 opportunity zone areas in the U.S. There's about 30 around the Triangle area in Raleigh. So there's some right downtown. There's some south of town, like in Clayton, Durham, Chapel Hill, are opportunity zone areas too. And with an opportunity zone investment, anything that you sell that generates a capital gain can be utilized in an opportunity zone investment. So if you have appreciated stock and you sell it and you're facing a capital gain tax, you can invest in an opportunity zone and help with the tax bill. If you sell a business, any portion of the business sale that's a capital gain is eligible. And then real estate too. You can sell real estate and use opportunity zones as a tax strategy. As long as it's a capital gain, it's eligible for an opportunity zone investment. And the way the tax code is written right now is there's one big benefit that you get this year for an opportunity zone investment. So let's say you sell a business this year, you'll have 180 days to take any portion of that sale and invest it in an opportunity zone fund. If the $1 million over the course of 10 years grows to 2 million or 2.5 million, then when the property is sold that the opportunity zone fund owns, all of that growth is tax free completely. So there's no tax bill due on the growth of your investment itself. You do have to hold it for 10 years to get that tax free growth. So the way it is right now, it's kind of like a Roth IRA, where in a Roth IRA, you pay your tax now and then you get tax free growth in the future. It's really the same right now with an opportunity zone fund. If you sell something this year, you have to pay your tax bill next year when you file your taxes. but the investment itself grows tax-free. As long as you hold it for 10 years, then whatever it turns into, there's no tax bill due at the end. That's all getting a big boost too. So starting next year, there's two more benefits that'll come in. So let's say you sell a business, and you can almost think of this for the third and fourth quarters this year too. So let's say you sell a business in September and you've got $1 million in sale proceeds. If you make your investment January 1st next year or later, and you're able to do that because you get 180 days to invest.
Mm-hmm. Mm-hmm.
So if you invest January 1st or later next year, you'll get a 5-year deferral on your tax bill. So let's say your tax bill from the sale of the business is 25%. So you owe 250,000. You wouldn't have to pay that tax bill for 5 years if you invest in an opportunity zone fund. And then before that tax bill comes due in 5 years, you'll either get a 10% or a 30% reduction in the amount of tax due. The variable in that is if you invest in an opportunity zone fund that's developing properties in a city or a suburb, then you get a 10% reduction in your tax bill. If you invest in one that's developing properties in a rural area, and the way the IRS defines rural is 50,000 people or less living in that zone, then you get a 30% reduction in your tax bill. So your tax bill gets deferred 5 years. It gets reduced also by this 10% or 30% amount. And then it gets eliminated too at the end. Whatever you put in the fund, as long as you hold it for 10 years, just like the current tax code also provides, then whatever growth you have in the fund, all that is tax-free as long as you hold it for 10 years. So this will all start January 1st, 2027. So we're about 9 months away from it. You might wonder, well, why would I do one now? If it's getting so much better next year. If you sell something this year, you'll have 180 days to place any funds in a QOZ fund. So you might not be able to wait till next year if you're selling something, in March, April, May, June this year. So if you make the investment this year, let's say you sell a business for $1 million and you decide to pay your tax today, and these are the tax rates I'm using here. I'm using 5, so yours would be a little bit lower. And then you've got this one and this one. So tax bill is about 288. So after tax, you'd have about 712,000 to invest. Let's say you put it in the stock market, and then the stock market makes 10% a year for the next 10 years. And then in 10 years, you sell your stocks and pay your tax bill. You would have about 1.5 million in 10 years if tax rates stay the same. After taxes, you'd have 1.5 million. If you did the opportunity zone investment and you put $1 million in, you still have to pay your taxes next year. But if the fund also has a 10% rate of return, just like the stock market, because of the tax-free growth part of that, it grows exponentially. And then after taxes in 10 years, it could be worth 2.3 million in total value after taxes. So doing it this year, there's still some significant benefits. And then next year, it does get even better because of that tax deferral and then the step ups in basis that you'll receive, essentially reducing your tax bill before it comes due in 5 years. So on the real estate side, most people will use the 1031 when they're selling real estate, just because anything you reinvest using the 1031 tax code, you'll defer all your taxes on. And then as long as you keep doing 1031s, then you keep deferring that tax bill. And then ultimately, if you pass the investment on to heirs, they get that step up in basis and don't have to go back and pay the old tax bill. So it can provide income during the life of the investor, growth. And then when you pass the growth on to your heirs, they don't have to pay taxes on that either. On the QOZ side, it's eligible for the sale of anything. So that could be the sale of stock, it could be a business sale, it could also be real estate. Sometimes you'll see people using the QOZ tax code if they didn't know how to do a 1031 exchange, where maybe they sold their property and then they find out later that you needed a qualified intermediary set up, or you had to buy the next property within 180 days and they didn't do that. So you could always use a QOZ if you did not do a 1031, and you have 6 months from a sale of anything, including real estate, to use the QOZ funds. Sometimes people will combine these two tax codes. So let's say it's a dental practice, or something like that we were talking about earlier. And the real estate is owned by the business, but there's also equipment and goodwill and the name of the business and everything else that would generate a capital gain. As long as the CPA assigns a value to the real estate part of the sale, and the investor has that sent to a qualified intermediary right at the sale of the business, then they could do a 1031 with the real estate part. And then the other gain from the sale of the equipment, the name of the business, any other thing that generates a capital gain tax, you could use a QOZ for that. So I have had some people combine the two tax codes, especially if it's a business that owns real estate. So let me pause there too and see if there's any questions on either one of the tax codes.
Yes, I think, Joe, a lot of times in that example you gave with the dentist, a lot of times they've done a pretty good job, I think, of separating, because they usually have placed the real estate in its own LLC,
Right.
and they're usually paying rent from the practice to the to the LLC, so they keep it really clean from that standpoint. So I think it's kind of easy to separate it when it's done properly like that up front.
Yeah, it's real common. As long as the proceeds from the real estate portion of the sale are sent to the intermediary,
Mm-hmm.
you can do a
Mm-hmm.
1031 with that part. So that's really the item that just needs to be set up
Mm-hmm.
before the closing date of the sale.
Mm-hmm.
But if you do the 1031 with the real estate part, then you can defer those taxes indefinitely. And then any other capital gain liability from the sale of the business itself, you could consider a QOZ investment for that. And it doesn't have to be all or nothing. Like in the 1031, the minimum investments are typically 100,000 in any
Mm-hmm.
one of our DST funds. The QOZs are a little lower; they're 50,000 minimums.
Mm-hmm.
So you could decide to pay your taxes on some of the money and invest in something else. And then anything you invest, following the rules of the tax code, you'll get the tax benefits on those investments.
Wonderful, wonderful. So in a perfect world, because of the sort of gap year we have with the QOZ, ideally, if we can get a closing July 1 or later, that really takes us to that second level that you were
It
speaking of.
does. Yeah. If there's a sale in the second half of the year, then if you make the investment in January, you're within
Mm-hmm.
your 180-day window and you'll
Mm-hmm.
get those enhanced tax benefits. If the sale's coming up and you just don't want to affect, the likelihood of the sale or the
Yeah.
results of it,
Yeah.
maybe you don't want to try to delay it and mess up the deal,
Right.
but if there's discretion, if it's a sale
Right.
that's going to happen in July or August and you can kind of pick the close date, it does make sense to try to get the new benefits if you can.
Sure. 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 Awesome. Yeah. Yeah. That was one of the biggest things. Because you had talked about it last year that was going to be a little bit of a challenge for us this year and why didn't they? So let me ask that then. Was there some reasoning in the negotiations of the new tax law where I'm assuming it was a revenue play where this kind of got pushed out and other tax things kind of came in
So
this year?
the original tax code, the original QOZ tax code,
Mm-hmm.
first came out, there was a deferral of taxes
Mm-hmm.
initially, and also these reductions, the step ups in basis, but
Mm-hmm.
they phased out. So
Mm-hmm.
the only benefit right now is the tax free growth part at the
Mm-hmm.
10-year mark. If you hold the investment for 10 years, all these studies have come out over the past 24 months that are measuring the impact that the communities felt that got these investments from QOZ funds that were developing
Okay.
properties in the areas. And it's very positive. So the unemployment rates went down, average income went up because jobs were created. And then the tax revenue went up for the municipalities and the counties, which helps with improving schools and public services and things like that. So there's been a lot of support for it. And then it was part of the new tax plan that goes into effect next year. So they did enhance it. And the 1031 was left untouched. So there's no changes with the 1031 tax code. That's going to be exactly the same next year.
Mm-hmm.
But they did put in these new benefits for the QOZ. And a large part of the reason was just the effectiveness of it. And
Mm-hmm.
that they want to continue that. They want to be able to continue attracting investments to these areas. The IRS has to set the new maps with all the new zones.
Mm-hmm.
So they haven't done that just yet. That should be done by the end of April. And all the governors of all 50 states have submitted the areas that want to be considered to be included in it. And now the IRS has to set the maps and the zones. So as soon as that's set, then we'll set our strategy for our next fund that we're going to offer to coincide with the new tax code and also these new areas.
Awesome. That's very helpful because I know there were a lot of trade-offs in where we're going to generate revenue from in the, for the Social Security enhancements and the additional standard deductions and the
Sure.
increased, child tax credit. So
Right.
I was figuring that's probably why this kind of got kicked down the road a little bit as part of that deal making.
There's one other thing maybe to mention too, Marcus. If you do have clients that aren't experiencing a capital gain, either from the sale of real estate or any other asset, and they just want to invest
Mm-hmm.
real estate as an asset class,
Sure.
you can do that into our real estate investment trust. And that one just has a $2,500 minimum.
Mm-hmm.
The yield right now, the income is 5.42. 100% was tax sheltered last year. So for a high income earner, the tax equivalent yield's more like an 8.5%,
Mm-hmm.
comparing it to something fully taxable. It's a 1099 at the end of the year, so real simple tax reporting. And with that, it revalues every month. So you do see a valuation every month, pays monthly income, and it's liquid with monthly redemptions if you wanted to cash out of it or rebalance your portfolios. So that program that we have, it's focused on some of these other sectors in real estate that have done above average kind of over the last 10 years or so. Self-storage, healthcare related properties, student housing are the main sectors in there.
Yeah, and that makes sense because of the, student housing crisis. I mean, once you're at least a lot of the North Carolina schools, I believe, after your freshman year, you're pretty much on your own as to
Right.
where you might live the next year. So it's that definitely makes sense. And then with the longevity of people living longer, of course, your facilities, your healthcare facilities are really as well experiencing growth there. So awesome. So again, I think, gosh, Joe, as always, you covered it. Your knowledge is just superior in this area, and that's why Jeffrey and I have seen you in person twice, and gosh, hopefully we can catch you next week when you're in town.
Yeah, sounds
And
good.
yeah, absolutely. So everyone, again, thank you for joining. As you can see, this isn't just for real estate investors necessarily. It's for business people selling products and capital gains. Just your average investor. It gives you another place to go to have money and tax advantage types of investments. So again, Joe, we thank you for taking some time this evening. And we know you're on the road, so we want to let you get back to it because we know you got some driving to do. But thanks again, and
You're welcome.
we'd love to have you again. So maybe third quarter of the year we'll bring you back on with any updates.
That sounds good. I appreciate the opportunity to talk with you and hope to see you guys next week in Raleigh.
Sounds great. Thank you, and thanks everyone for joining.
Thanks, everybody.